This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 4 videos on trading in trading ranges. A trading range is a channel that is horizontal. Like all channels, trading ranges can be broad or tight. Sometimes when a trading range begins, it's not all that clear, but I'm always paying attention for signs that one might be forming. This is the euro versus the dollar 5-minute chart. And you can see it has legs up and down lasting 20, 30, 40 bars. Clearly a trading range. When it's broad like this, you can buy and sell for scalps and occasionally for swings. The general approach is to buy low, sell high, and scalp. Here are some examples of stop entries. We have 3 legs down, a series of bull bars, bull bar closing on its high. You can buy with a stop above that bar. Here we have a strong enough rally so that we might get a second leg up. We have a micro double bottom, a bull bar closing on its high. Plenty of room to the top of the range for reasonable buy. We have a parabolic sell climax, but forming a double bottom, a sell vacuum test of the bottom of the range, and a very strong reversal bar. And then here we have a wedge pullback, 1, 2, 3, and a decent bull bar, a reasonable stop entry buy. For the bears, a small spike in channel, wedge top, at the top of the range. Also a bigger spike pullback channel and a bear bar. You can sell there or a second entry short below this bear bar. Strong enough bear breakout, a tight channel, second leg down likely. You can take either the first entry below this bar or higher probability, second entry below this bar, a 50% pullback and a lower high, possibly a lower high major trend reversal. And then here, wedge top, 1, 2, 3, or 1, 2, 3, a double top bull breakout that failed, so it's a type of wedge. Here, a small double top breakout above this. It's probably also a wedge, 1, 2, 3, second entry, and a lower high at the top of the range. A bigger wedge, 1, 2, and then 3, micro double top, good looking bear bar, testing the top of the range, a failed breakout above this major lower high. When the market's in a trading range, a lot of traders like to enter with limit orders. They look for breakouts near the bottom of the range. At this point, this is the range. Traders will buy with a limit order at that low, or on the close of this big bear bar, betting the bear breakout will fail. Here we have a bear flag, but it's a bull IOI, a bull bar inside of another bull bar, and we're starting to get bull bars. It's probably not going much lower down, so some bulls will place a limit order to buy at the bottom of that bull bar or the bottom of this bull bar, betting that will soon reverse up and test maybe the top of the most recent sell climax. Here we have a parabolic wedge sell climax, but it's forming a double bottom, and the market is reversing up strongly. We have 6 bull bars. The first reversal down probably will fail. Traders will place a limit order to buy at the low of the prior bar, and they would get filled right here when this bar fell below that bar's low, looking for at least a second leg up, maybe to the top of the most recent sell climax, maybe to the top of the trading range. When the market gets near the top of the range, traders start to look for failed breakouts, and they'll sell at prior highs. Here's a small high. Traders will sell at that high, betting that the market will have a hard time getting much above here. Here we have 3 bear bars, 5 bars down without a bull body, strong enough reversal from the top of the range and from a wedge top. We'll probably get at least a small second leg down. Traders will place a limit order to sell at the high of the prior bar, and they'll get filled here when this bar went above the high of this small bear bar. Trading ranges oftentimes have strong legs that last 20, 30, or 40 bars. During a strong leg, the market's in a trend, and it's clearly always in short. And when that's the case, traders can buy high in a strong bull leg, and they can sell low in a strong bear leg, betting that the trend will continue. strong reversal down. Traders will bet a reversal will be minor and fail. They'll sell with a limit order above the high of a bar. This is about an 8 or a 10 bar bear microchannel. First reversal up will probably fail. And now we have a small double top bear flag. Bears will sell with a stop, betting the reversal down will continue. Strong bear breakout, 2 legs up, 1, pause, 2. Traders will sell below the bear bar, betting that will fall at least a little bit further. Here we have a higher low and a double bottom after a fairly tight bull channel, probably going higher. Very strong series of bull bars, probably going higher as well. Traders will buy above bars. Here we're trying to get a double top here, double top here. Some bulls would buy with a stop above it. Others will buy as this pullback bar tests that high. They'll place a limit order just above this high and then get filled near the bottom of that bear bar. A stop entry buy, very tight bull channel, likely to get at least a little bit more up. Tight bull channel, first reversal down, likely to fail. Traders will buy with limit orders below bars. 2 bear bars, traders will bet the market will not get a third. They'll either buy the close of the second bear bar or they'll buy below its low, betting that will get at least a little bit more up. Strong bear breakout. Bull trend. Bulls were hoping for a bull flag. We have a surprise here. Surprises usually lead to at least a little bit more in that same direction. The reversal up will probably fail. Bears will sell with a limit order at the high of the prior bar. And then we have a low 1 sell, a small double top. We went up and down here, and then up, probably down here. So they'll sell with a stop below the low of the prior bar for a little bit more down. The market is trying to get very small bars and sideways bars with very prominent tails. We're forming a small range and it's very, very tight. When it's as tight as it is here, very difficult to make money, even entering with limit orders, unless you're willing to scale in and use wide stops. When you're in a very tight range like this, it's usually better not to trade. A trading range is a channel, but it's a horizontal channel. When the market's in a bull channel, you want to buy in the lower half. When the market's in a bear channel, if the channel is broad, some traders will buy in the lower half looking for scalps. When the market's in a bull channel, if the pullbacks are deep, bears will sell in the upper half looking for scalps. When the market's in a bear channel, bears are always going to be selling, looking for a swing or for a scalp. And when the market's in a trading range, traders want to buy low, sell high, and take quick profits, scalp. In general, the market spends very little time in the lower third and very little time in the upper third. However, that is the area where traders should try to enter. You should try to buy in the lower third. In channels that are bull channels or bear channels, traders try to buy in the lower half, sell in the upper half. In a trading range, it's better to focus on the lower third and the upper third. Sell in the upper third. You can see the market spends very little time there and very little time here, but a lot of time in the middle. Entering in the middle is very difficult to make money unless you're willing to use wide stops and scale in. There are signs that the market's in a trend. There are signs that the market is probably beginning to form a trading range. I'm always paying attention to context. Context simply means the bars to the left. And I interpret what's going on here in part based upon what's going on here. And the same is true here. Both are strong bull breakouts. But knowing that is not enough. I want to know what took place before. We have a strong bull breakout. And before it, there was a trading range, and the market broke strongly above the range and had good follow-through. When the breakout extends far above the prior bars, it's more likely the start of a bull trend, a bull leg, and what will become a bull trend. On the other hand, this bull breakout followed this, and it did not go above the high of the bear reversal. Therefore, this bull breakout is more likely a bull leg in a trading range and not the start of a bull trend. Here, the breakout was followed by pullbacks and then a channel. So a spike, pullback, channel, spike and channel, bull trend. And here, big up, big down, confusion usually results in a trading range. Big down, big up, confusion usually results in a trading range. Strong bear breakout, 5 consecutive bear bars closing below their midpoints. 4 of them are closing near their lows. 3 have very big bear bodies. That's good selling pressure. Whenever you see a strong breakout like this, the first reversal up will probably be minor. That means instead of reversing into a bull trend, probably the best the bulls can hope on the first reversal up is a bull leg in a trading range. This is probably going to be either the start of a bear trend or a bear leg in what will become a trading range. Even if the bulls get a strong reversal up, the reversal will probably fail and test back down near the low. Beginners, when they see the series of big bull bars, all they think is bear trend. It's got to be a bear trend. It does not have to be a bear trend. It's probably not going to be a bull trend, but it could be a bear leg in a developing trading range. Experienced traders know that what I said is true. You get a strong bear breakout, 60% chance you're going to get a measured move down, but 40% chance you could get a pretty deep reversal up. If you do get that reversal up, the market will probably be in a trading range. At this point, maybe less than a 20% chance, 10% chance, it can immediately reverse up into a bull trend. Strong bear breakout, so either a bear trend or trading range is likely. But if it's a trading range, you can get a very deep pullback up all the way to the top of the range. We're getting a strong reversal up after a double bottom. Big down, big up, big confusion usually results in a trading range, not a bull trend. This rally, as strong as it is still below the top of the sell-off. It's therefore more likely a bull leg in a trading range than the start of a bull trend. Big down, big up, big confusion. The bears were disappointed by this. The bulls will probably be disappointed by what we don't see to the right. With that strong reversal up, the bears who were confident that the market was either going to be in a bear trend or a trading range now believe it's probably in a trading range. And the bulls think that as well. They're hoping for a bull trend, but they see big down, big up. Most reversals lead to trading ranges, not opposite trends. Strong reversal up, probably a bull leg in a trading range. When you're in a trading range, it's never all that clear where the top and bottom of the range is until after you get a pretty good reversal in the opposite direction. Once you know it's in a trading range, my 80% rule says that 80% of breakout attempts up and down will fail. Traders therefore sell near the top of the range and scale in higher, use wide stops, and they buy near the bottom of the range, use wide stops, and experienced traders will scale in as well. Bulls clearly disappointed by this, and you can see we have a series of strong bear bars here, bearish, a series of strong bull bars here, bullish, but now we're getting bear bar, bull bar, bear bar, bull bar, bull bars, bear bars. We're getting a lot of very quick reversals. This is an early sign of a trading range. A beginner thought it was a bear trend, and then he thought it was a bull trend, and now we have consecutive bear bars. He's thinking it's a bear trend again. This close is below this low. Maybe we'll get a measured move down. Gap between the close of that bar and the low of that bar. This might be a measuring gap from this high to this low down to here. However, experienced traders are thinking that the market is starting to reverse too frequently and pausing. This is probably going to be an exhaustion gap in a bear leg in a developing trading range instead of the start of a swing down. Two legs down to a higher low, a double bottom, higher low possibly with this bar. Trading range more likely than bear trend. Bull reversal bar, couple legs up. Again, bull bar, bear bar, couple bull bars, small bodies, big tails, immediate reversal. The market is beginning to form a trading range. And that continued for many more bars. Beginners see 5 consecutive bull bars, and they're thinking, okay, the trading range is ending. We're breaking above a double top here, and we're breaking above a prior high here. Therefore, maybe the start of a bull trend. It's possible. But look at your 5 consecutive bull bars. Doji, doji, big tail. Look at the size of the bodies compared to the bodies here and here. Not especially big. Trading ranges often have second leg traps, 2 legs up and down, 1 pullback 2. And the second leg is often very strong, yet it still reverses. 1 pullback 2, bears trying to get a breakout, reversed up. 1 pullback 2 could be a second leg trap testing the top of the trading range. Experienced traders will sell strong rallies and buy strong sell-offs, knowing that 80% of these breakout attempts up and down will fail. The strong second leg is a breakout, but traders know breakouts typically fail when the bars to the left are in a trading range, and therefore it traps beginners into buying high, or it traps beginners into selling low. Now, beginners see 5 bear bars closing below their midpoints, and 6 bars down, 7 bars down, and they're hoping that it's the beginning of a bear trend. Skilled traders expect that the bears will be disappointed. They were disappointed here, they were disappointed here, they were disappointed here. Bulls were disappointed here, bulls were disappointed here. What's the chances of this becoming a bear trend? Well, 80% chance every attempt to become a trend will fail. Skilled traders will be buying these bear closes around a prior low, and they'll be buying a reversal up, betting that as strong as this is, it's probably simply another leg in a trading range. Disappointment is useful. If you're a trader and you see this, you know the bears are disappointed, and then you see this, the bulls are disappointed. You're seeing disappointed traders up and down. Disappointed bulls, you have to assume the bears will be disappointed as well. When you see that kind of disappointment, you have to expect that the market is going to reverse every time it starts to break out. So understanding disappointment is helpful. Whenever you look at a chart and you see setups that look like they have pretty good probability, but they're not working, and this happens repeatedly, and then you also see probabilities that do not look like they have a very good chance of working, they end up working, you know the market's in a trading range. The probabilities are never as high as you want them to be, and the things that you think are low probability are much higher probability than you think they should be. Probabilities tend to gravitate around 50-50 instead of 40 and 60 as they do in trends. Five consecutive bear bars, reversal up, unlikely to lead to much of a rally. It's a low probability buy, yet it led to a profitable swing up. 4 consecutive bull bars, probably a minor reversal down, yet it carried down for 20 bars, much further down than what you would expect after 4 big bull bars reversing up after a big sell-off. Higher low major trend reversal after a good rally, but the market went sideways for 30 bars. Bulls trying to get a double bottom bull flag, a decent bull bar, another bull bar, yet the market reversed down. Here's a 60-minute chart of the euro versus the dollar. Trading ranges are contained between support and resistance, and every reversal down creates new resistance. Every reversal up creates new support. Extremely strong breakout, but it failed to get above the top of the range. Prior highs are resistance. And prior lows are support. When the market gets near support, it'll reverse up. Sometimes it'll fall below support and then reverse up. The support keeps the market from falling too far, and the resistance keeps the market from rallying too far. The bulls and bears are balanced, and they keep alternating control. And the bulls make money during the bull legs. The bears make money during the bear legs. Both are making money. Both alternate control, and sometimes the control lasts a long time, 30 or 40 bars. Sometimes it's brief. Trading range like this, here we have probably a couple hundred bars, 300 bars, lots of legs up and down. Whenever you see a rally lasting 10, 20, or 30 bars and the market's clearly always in long, and then you see a sell-off 10, 20, or 30 bars and the market's clearly always in short, you have to assume you have big up, big down, and that the market's in a trading range. Sometimes the sell-off comes first and you get big down, big up. Always in long, always in short. A reversal. Most reversals lead to trading ranges, not opposite trends. The market's probably going to be in a trading range. You usually need at least 2 legs up and down in a sideways market to conclude that a trading range is more likely than a trend. When you look at the legs and they have lots of hesitation, lots of prominent tails, lots of pauses, that is trading range price action. Lots of small, tight trading ranges within them, that further increases the chances that the market's in a trading range. Look at all the prominent tails here, all the reversals here. When you see 2 legs up that reverse or 2 legs down that reverse, even if the legs have smaller patterns within them, 2-legged patterns that keep reversing is another sign that the market's in a trading range. 2 legs down, the market at this point is probably in a range. This is the current high of the range. This is the current low of the range. And the range continued throughout the next couple hundred bars. It went to a slightly higher high, but reversed. The breakout failed, as is the case with most breakouts when the market's in a trading range. The chart's filled with 2-legged moves, and they're nested. They contain smaller moves within them. This is an attempt at a wedge, and then we have a very strong breakout, a second leg trap. 1, pullback 2, and it's subdivided. It's also a spike and channel, spike, pullback channel, wedge channel, 1, 2, 3. Smaller 1, pullback 2. First one is a wedge, pullback breakout, a small second leg trap. Very common, first leg a wedge, second leg a breakout attempt above the wedge, a common second leg trap pattern. 1, pullback 2. Big 1, 1, pullback 2. Nested. There are smaller patterns within it. 1, pullback 2. Markets are fractal, and that simply means that within every pattern, there are smaller versions of the pattern. Also, whenever you see a pattern, it's probably nested within a bigger pattern on a higher time frame chart. Breakouts tend to contain smaller breakouts, and trading ranges tend to contain smaller trading ranges. A trading range contains smaller trading ranges. A breakout contains smaller breakouts. Here's a breakout. It contains a breakout here and another breakout there. This breakout, if you looked at a smaller time frame chart, probably has pauses along the way. You can see this tail up here. That means the market reversed down, and that means it contained at least two breakouts, a breakout, a pullback, and another breakout. Big trading range contains smaller ranges. The market had a range here, broke to the upside. It was in a range here, broke to the upside. So this entire bigger range is containing smaller ranges. And the smaller ranges contain other smaller ranges. The market's in a trading range here, broke out. Tried to be a trading range here, broke out. Trading range here, broke out. Trading range here, broke out. Again, even smaller ranges. A doji bar, a bar with a very prominent tail and a small body. Sometimes the body's at the top, usually the body's in the middle. Those are one bar trading ranges. And if you looked at a smaller time frame chart, you'd see that within that bar, there is a smaller trading range. The more signs of a trading range that you see, the more likely the market's in a trading range, and therefore you have a better chance of making money if you trade it like it's in a trading range. Many of the legs, even the very first leg, even the first bar, can give you information that the market might be forming a trading range. All trading ranges end. Eventually, a breakout will be successful. However, traders will trade it like a trading range until it clearly is no longer a trading range. If they trade it like a trading range, buying low, selling high, and scalping, they'll make enough money to offset an eventual loss when the market becomes a trend, either a bull trend or a bear trend. One of the things that you often see is trend bars that just don't look quite right. Here we have a pair of bull bars with fairly prominent tails on top. And the same here, we have 4 consecutive bull bars. 3 of them have pretty big tails on top. That's more common if you have a bull leg in a trading range, less common in a bull trend. We have a pair of bull bars, but then a doji bar, and then a resumption bar, but a tail on top. And then we go outside up, and then we have the biggest bull bar in the entire trend. That is more likely an exhaustive end of the trend than the start of an even stronger leg up. We're trying to get trend resumption up here, but the bodies are not all that big and the tails are fairly prominent. We're having a bear breakout and consecutive bear bars, but the bars have tails on the bottom. That means the bears are less certain the market is going down and they're taking partial profits right before the bar closes. And it means bulls think it's a bear leg in a trading range and they're scalping, possibly on a smaller time frame, but they're buying every sell-off. Same here, another breakout, but a big tail and possibly a higher low. Doji's over here, sign of indecision. Even a tail on top of the bar is a sign of indecision because that tail was created by a pretty good reversal up. It failed, however, the bulls were able to reverse up. Prominent tails below bars at the bottom of the range, prominent tails above bars at the top of the range. That's a sign that traders are selling. Bulls are selling to take profits. They're betting against a successful breakout. If the bulls were confident, the market would keep going up. It wouldn't sell off repeatedly like this. The bulls are not confident that the market's going higher, and they're selling when the market's high. And the bears are selling as well, betting against the breakouts. And the opposite is true at the bottom. The bears are not confident the market's going down. and anytime it goes down, they buy, and a lot of bars reverse up. A lot of bars are small and have prominent tails. That is brief, tight trading range trading, very common when the market's in a big trading range. Lots of tight trading ranges, lots of time when the market is going sideways in a fairly tight range. That is trading range price action, and these tight ranges are often a sign that the market is probably within a big range. A trading range is a channel that's simply horizontal, and like any channel, it can be broad or tight. And with any channel, you want to buy low and sell high. Traders need to decide that the market's in a trading range early, so they start to trade it appropriately. When it's in a trading range, you want to buy low, sell high, and scalp. And you have to assume that breakout attempts up and down will fail repeatedly. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading in trading ranges.